Hi, everyone. Welcome to our webinar. This is Juan Carlos Ordóñez, Communications Director here at the Center. Thanks so much for taking the time out of your busy day to join us. And let me start off by thanking our donors who make this webinar and all of our work possible. So thank you very much. We're excited today to have here Representative Barbara Smith Warner. She is the Vice Chair of the House Committee on Revenue and Co-Chair of the newly created Joint Committee on Student Success. Representative Smith Warner will be giving us her take on the just concluded legislative session in a moment. But before we get to her, we're going to give you our assessment of this session. And this was a particularly busy session for us here at the Center. We worked on bills ranging from an effort to strengthen temporary assistance for needy families, to increasing protections against wage theft, to a number of tax policy bills. And certainly efforts to prevent new tax breaks and loopholes from being created. But in the interest of time, because there's so much that happened, we're going to focus on one item that took a lot of our time here this session, and that was how Oregon should respond to the Trump tax plan. And in particular, to a new tax deduction for pass-through income. And so my colleague Daniel Hauser will be walking us through the work that we did and where that stands. And after Daniel gives us that overview, we will hear from Representative Smith Warner. And then we're going to open it up to your questions. So we're happy during the Q&A portion to answer questions on any topic, be it TANF, wage theft, and tax policy, anything that you want to throw at us. Before we get started, just a couple of housekeeping matters. Feel free to send your questions at any time. Certainly, if an idea pops into your head, send it in. Just please use the Q&A function on your screen. And also, please know that we'll be recording this webinar and making it available. So without further ado, here is Daniel.
Thanks, Juan Carlos. Here at OCPP, we started planning for how to improve Oregon's tax and revenue policies in 2018, not long after the 2017 legislative session ended. One of the tax changes that we prioritized in 2017 was ending Oregon's reduced tax rate for the profits passed through business owners, such as partnerships, S corporations, and LLCs, passed through onto their individual tax returns. This was the main point of our last webinar, so I recommend watching the recording we have on our website to learn all about it. But the simple version is that if you earn wages, you're taxed at Oregon's normal personal income tax rate. If instead you're the owner of a pass-through business, you pay a lower Oregon income tax rate on your first $5 million in profits. In 2017, the Oregon legislature considered trimming back this reduced tax rate, but that effort fell short. This state tax break, an expensive and poorly targeted tax break for rich business owners, was one of the key tax policies we knew we wanted to address in 2018. Working with Tax Fairness Oregon and the Oregon Center for Christian Voices, we began recruiting other organizations to join us in a coalition to fight to end this tax break for pass-through businesses in Oregon. At the same time as we were getting ready to go after the state pass-through business tax break, the Trump tax scheme was gaining momentum in Congress, including, at the same time, weighing in at hundreds of pages and including last-minute handwritten scribbles, this extensive package of changes to federal taxes was pushed through Congress with little public engagement. The president signed the bill in late December, hardly more than a month before Oregon's legislative session began. And I've included here a literal example of just how legible the edits to that federal tax bill were when the Senate was finally having to vote on it. This left us scrambling to understand what all these far-reaching changes really meant for Oregon after the president signed it in late December. And while there were many tax changes worthy of attention, there was one that really caught our eye. The Trump tax scheme created a new 20% tax deduction for pass-through business income, meaning a pass-through business owner could cut off 1/5 of their annual profits before calculating what taxes they owed. Never one to pass up an opportunity to make taxes more complicated, Congress added additional formulas to calculate this new deduction and excluded businesses operating in certain industries if the owner had more than $415,000 in income. Unfortunately, many of the definitions Congress created as part of this new tax break were very vague and are already being fought over in rulemaking and will certainly end up being litigated. There was one example that was recently reported on how because they Industries that are exempted include ones where the business's reputation is part of the reason that they're successful or that they're sought after for their business. That perhaps some restaurant owners where the chef is kind of the reputation behind the business might not get the tax break, whereas other restaurants who simply have chefs as part of staff will get the tax break. And so there's a lot of confusion around how this will end up working out. And starting in the current tax year, Oregon pass-through business owners can start deducting this benefit from their federal income taxes. And unfortunately for Oregon's budget, this new federal deduction was automatically replicated in Oregon's tax code. Because Oregon has in place what's called a rolling reconnect, many changes in federal tax definitions and policies are automatically made a part of Oregon's taxes. Thankfully, the Oregon legislature can actively disconnect from tax definitions if they so choose. It's worth noting that many states did not automatically connect to this policy. Pass-through business owners went from getting a reduced tax rate on their Oregon income taxes to getting that tax break and a new federal tax deduction and a new state tax deduction because of our connection. The coalition we've been building with help from our allies realized that if Oregon connects to the pass-through deduction, it would cost the state hundreds of millions of dollars in foregone revenue, undermining already inadequate investments in our schools and other important public services. We made the tough decision to focus our efforts on disconnecting from the federal pass-through deduction and to come back in 2019 to fix Oregon's reduced tax rate for pass-through profits. That brings us to February 5th, when the legislature began the 2018 legislative session. We began pushing arm in arm with our many partners for Oregon to disconnect from this policy, which was then estimated to cost Oregon over $1 billion during the next handful of years. And I've included the breakdown for each of the next two budget periods as well as our current budget period here for folks to see how this really grows with time and costs the state, like I said, over $1 billion. Many legislators quickly realized the problem connecting to this policy would cause and the insanity of giving business owners a third tax break on their profits when teachers, firefighters, and regular folk who earn wages get none of these three tax breaks. Proponents of Oregon connecting to the pass-through deduction sprang into action, sensing that this was a complicated policy and they had an opportunity to sow confusion. Claims that this raised taxes on small businesses were repeated again and again, yet were no more than a smokescreen. Most of the benefits of the pass-through deduction at the federal level flow to the highest earning top 5% of Oregonians, not to struggling small businesses. And you can see here in this slide that the bottom 80% of income earners in Oregon would share only 7% of this tax benefit. True small businesses would benefit more from investments in workforce training, education, and affordable housing than this state tax policy would ever provide. Senate Bill 1528 became the vehicle that was going to disconnect Oregon from this costly tax break, and the Senate quickly began hearings. Initially, the bill would have made some progress on trimming back the state pass-through reduced tax rate, which I mentioned earlier in this presentation, as well as cutting the taxes of working families through expanding the personal exemption credit. Unfortunately, both of these items were stripped out of the bill, and the Senate passed this slimmed-down version, which disconnected Oregon from the pass-through deduction. Next, the House passed Senate Bill 1528 in the waning days of the legislative session and has now been sent to the governor for her signature. However, this is not where the story ends. Groups making the misleading claim that this is a tax increase on Oregon's small businesses have been pushing the governor to veto the bill. This common sense decision by the Oregon legislature to reroute hundreds of millions in taxpayer funds away from wealthy business owners and back to Oregon schools and other crucial public services has become a bit of a political hot potato. There have been calls for the governor to veto the bill, which would be a mistake. In an effort to ensure the governor does sign the bill, OCPP and our partners have been asking our friends and followers to reach out to the governor and ask her to sign Senate Bill 1528. Oregon cannot afford to lose over $1 billion out of already tight budgets. Rich business owners don't need a third tax break on their pass-through business profits. Governor Brown needs to sign Senate Bill 1528. I'd ask everyone on this webinar, either now or when we conclude, to please visit ocpp.org/action-alert, which is the link on the site, and send her a message. This will let the governor know you are with OCPP and encouraging her to sign Senate Bill 1528. And without further ado, I want to introduce the always insightful Representative Barbara Smith-Warner to share us some of your thoughts.
Well, thank you. Thank you for having me, Daniel and Carlos, and everybody here at the OCPP. You know, short session is always an exciting couple of weeks. My kids like it better because it means I'm only gone for about 5 weeks instead of the 5 months that I am during the long session. And I, in some ways, do too. It's really intense, but the last couple of short sessions since I have been in the legislature, we've managed to do some really big, important policies in the short session. And I would say, this year was no exception. You've already talked about Senate Bill 1528 and the importance of getting that signed by the governor. I could not agree with you more on that. I and many of my colleagues have been sending the governor that same message and continue to do that. We passed two. I did want to mention one other place where we disconnected from the Trump tax scheme that was important as well, even though, as so often happens in the legislative process where there is a lot of give and take, I think we could have made it even stronger. So Senate Bill 1528 was where we disconnected from the kind of double dipping giveaway tax break that small businesses are going to receive at the federal level. There is another scheme, and I've been enjoying using that word, so I'm going to keep using it. There's another part of the Trump tax scheme that in theory is a great idea. Right now, as you and I'm sure many of your listeners know, there is a perverse incentive in the U.S. tax structure to basically hide money offshore. U.S. companies have subsidiaries, and they will stash profits because they claim that the U.S. corporate tax rate is too high, so they will stash it in various tax havens around the country, around the world. And so in Oregon, we have actually had some legislation to try to account for this, because corporations pay only on the percentage of their profits that comes from their business in Oregon. And so when there are corporations that have some of their business and their profits hidden in these tax havens, we have made them add that back into their overall dollar amount before they get charged their Oregon taxes. The one kind of credit I will give to this attempt at rewriting the federal corporate tax structure is that there is now an incentive, along with the dropping of the corporate tax rate, there is now an incentive for those corporations to bring back those gains into the U.S. and pay this now lower tax rate on them. There's kind of a 1-year grace period where they can bring these profits back in without being penalized. And for some, because of yet another quirk of the Oregon legislation, unless we had disconnected in this other place from the federal tax rate, those profits that those corporations were bringing back into the U.S. to have taxed finally would not have been taxed in Oregon. So we, in addition to Senate Bill 1528, I believe it was 1529. So Senate Bill 1529 was the other bill that disconnected in a different place that basically made it so any corporations that are repatriating, we call it, bringing that money back into the country, they will then have to pay Oregon tax on that as well, if they have not, if they have been hiding it in tax havens or in places where they weren't paying taxes on it before. The unfortunate trade-off with that is that tax haven law that Oregon has had got taken out by this, because the theory is, well, you're not going to have tax havens anymore, or you're not going to have corporations hiding money in tax havens anymore, so we won't need to have that. Well, I would argue, and Daniel and I have had this discussion, and probably a number of the people who are listening have had this discussion. This tax scheme at the national level is full of question marks and holes and mystifying changes that continue to not be fully understood. Over the course of the short session, we were continually refining our understanding of it. Our very excellent revenue staff in the legislature, tax attorneys were coming in. Everybody was really just giving their best guess at how this was going to play out. And I think that guessing will continue going forward. And I share the concern that this repatriation effort may not bring back the money into the U.S. that its proponents claim that it will. We in the House argued to put the tax haven regulations on hold. Fine. They're setting up this new system where supposedly the corporations won't be doing this anymore. Let's give them a couple years, but then let's check back and make sure that it has actually been done. So where we settled on is the tax haven was pulled out, but we are requiring a report back after, I think, the first 3 years of this to see. Now, it'll be a lot harder of a lift if indeed companies are still hiding profits offshore. It'll be harder to bring back that tax haven legislation than it would have been for it to just for us to put a short-term end on it and say, okay, we'll take it away for 3 years and then it comes back. But we will continue to track that going forward. And that ability for us to tax that repatriated one-time money is extremely important. So I think I'll pause there. I can talk about tax policy for a long time, as I'm sure both of you can as well. But I will take a quick pause to see if you have any specific questions about session issues.
Thank you very much, Representative Smith-Warner. And now we're going to open it up to your questions. So please use the Q&A function on your screen to send in your questions, be it tax policy or any other work that OCPP did during this session that you saw and you may have a question about. And we already have one question here from Chuck. The question is, should the governor veto the bill that repeals our provision that brings in income from tax havens? The one-time repatriation effort versus the tax haven legislation that is bringing in tens of millions each year.
That's an interesting thought. I had not thought of that. It is, I would argue, it would be less of a big picture impact. So I think what he's asking is if you're weighing the two things that you're getting out of Senate Bill 1529, which is on the one hand, you're getting the taxing ability for this one-time money, and that is a one-time revenue source. But on the other hand, losing the tax havens going forward is potentially a bigger long-term item. That had not occurred to me. I'm not sure. I hate to give away revenue that is, we have such an unstable revenue system in this state, as you well know. I hate the idea of giving away any of it for no, for no cause, an unforced error, as it were. And I believe that and particularly, we have designated that money that comes in as going to a fund to try to help deal with the PERS situation. And that is, I think that's an important thing for us to do both policy-wise and politically, to acknowledge that kind of ongoing concern and to provide a one-time source of money for that. But that is a really interesting idea about losing the tax haven. So I would say, probably not. I wouldn't recommend that, but I'm sure going to kind of put that in my head and think a little bit more about it.
Yeah, thanks for that, Representative. I'd also add that from our perspective here at OCPP, losing the tax haven law was a real mistake. And there's a number of provisions that all have cute acronyms that I won't go into in the new federal tax law that are intended to, as the representative mentioned, incentivize companies to not hide their profits in offshore tax havens. And we, in working with many of our national partners, have come to the conclusion, at least at this early juncture, that those are not going to be sufficiently effective, that our tax haven laws still would be really important. And so part of the question on whether or not the governor should veto this does hinge on how effective these new federal tax provisions will be, of which we don't know, and the jury is still out, but we think they will be less effective than they've been sold. And a lot of interesting commentaries coming out of some of the corporate tax law firms nationally saying that they believe they'll be able to prevent states from actually taxing a lot of that both repatriated and ongoing revenue that comes out of the federal tax law. So there is a possible future where Oregon doesn't actually gain revenue from fixing the repatriation and ends up losing our tax haven law. That said, there are also a lot of smart people who think that we will be able to tax that. As the representative mentioned, the Department of Revenue and legislative revenue officers have indicated they believe that to be the case. But the challenge right now with how quickly this bill was pushed through Congress is that we are still on the fly trying to interpret what the heck's going to happen and what it all means for for not only our federal income taxes, but Oregon state taxes as well. So thanks for that question, Chuck.
We have another question from Anne. She asked a question regarding corporate activities tax. And if I can sort of summarize it, well, one, does the corporate activities tax have a good chance of being enacted in 2019? And would it correct some of the problems that have been created by the Trump tax plan or with our corporate tax system?
Sure, that's a great question, Anne. I'm not sure I have an answer right away on the interaction with the Trump tax scheme. But again, that's largely a function of not being sure how it is ultimately going to play out overall. I do, however, want to put in a good word for the commercial activity tax as a concept. As somebody who has believed strongly in the need to stabilize and make our revenue system and make it more fair, I came into the legislature as kind of your standard believer in a sales tax. You know, everybody talks about the tax system, the three legs of the tax stool: property tax, income tax, and sales tax, and how Oregon is hobbled by the fact that we only have two. So first of all, we don't have a sales tax. Second, our property taxes are limited from Measure 5 in the early 90s. So that leaves us with an inordinate dependence on income tax, which is why individuals feel as though their income taxes are very high, because they are, because we have a disproportionate reliance on that, and that is a kind of tax that is really sensitive to the economy. So when there are good times, we are ahead of the curve, and when there are down times, we are below the curve. So it makes for a very volatile tax system. So again, I came in believing very strongly in a sales tax, and then in the work we did in 2017 about overall tax reform, I have become a convert to the commercial activity tax, because if you look around the country, states that have sales tax are also suffering declining revenues because the sales tax is not the always reliable source of income that it used to be. The changes in the way that we shop and purchase things, largely through online activities, is having a huge impact on states' abilities to thoroughly collect sales tax. So what the commercial activity tax would do is it would from an economist's perspective, it is one of the best kind of taxes, because what you can do in economist speak, and I don't think I'm certainly not telling Daniel anything he doesn't already know. In economist speak, the best tax is the one that is the broadest, that is implemented broadly at as low a rate as possible, because that is has a very significant tax fairness. So you want a broad tax that is low. A commercial activity tax would basically just be, it would be simple, it would be hard to get around and hard to game the system, in that every commercial activity, basically whatever at the end of the year, all the money, all the revenue that you had expended that year as a business, you would pay a small percentage of that, and that would be your taxes. No write-offs for this, no loopholes for that. The commercial activity tax would be a clean, hard to get around way to do it. And more importantly, it tracks with the economy. If you look at the corporate taxes and even sales taxes, they are not tracking with economic growth. A commercial activity tax does track with that. So all of that as preface, I believe strongly that the conversation that we will have about tax reform in 2019 will have that at its centerpiece. I don't want to completely avoid sales tax, because I've had conversations with numerous Republicans who that is one of their hangups about it, is they fear that you miss a lot of the tourism, and a lot of the tourism that we have in this state, all across the state. If you don't have some version of a sales tax, you are losing a really good income source. And so some combination of a commercial activity tax and a very targeted sales tax, I'm hoping will be the holy grail of what we get to, and including in that, perhaps finally a replacement for the education funding that was taken away by Measure 5 in the early 90s, that we can come out of that tax reform as well.
We have a couple of questions from Jody. The first is, why do we give up our own tax haven law? She's asking sort of who was pushing for that change? And second, whether we should keep talking about the corporate income tax and raising the cap on raising the corporate minimum tax.
Starting with the second, yes, I very much agree with raising the corporate minimum, certainly as a stopgap, if nothing else. In the 2017 session, we had this long, very vigorous conversation. There was a joint tax reform committee writ large, as well as smaller work groups with that. There was a lot of great conversation in which, to be blunt, the business community did not engage at all. They stonewalled, they avoided, ignored, and then in June, when it looked like we were going to make some real progress on this, they came in and said, no, how about if you just raise corporate tax rates and then we'll be fine. And this was the business community that had been, screaming against this for years, that that's the worst possible thing we could do. Faced with true, significant, meaningful tax reform of the commercial activity tax, they kind of came in with a last minute, how about if we do raise the corporate income tax? And we did not end up doing that because there was belief certainly in the leadership in the House and the House Democrats, that if you do that, you would be putting off or perhaps killing the longer term conversation about tax reform. That by doing that one kind of small bump in the corporate tax reform, you're killing the conversation for a number of years without having any meaningful change to the system. Because the corporate tax structure, it is not tracking with the economy. It is a flat to declining source of revenue given the ever worse and more confusing federal tax system upon which it is based. So do I agree with raising the corporate minimum? Sure. And I think it can be part of the bigger conversation. As far as the tax havens, all I can say is that the bill came out of the Senate with that in it. And in the House, we proposed a variety of ways to keep the tax haven law in there. And given a combination of timelines and other, I don't even want to say political realities, because I'm not even sure sometimes what they all were, but mostly a timing issue. The concern was that our ability to pass both of those disconnects without the session ending and adjourning, in which case we would lose our ability to do them at all.
I think the representative raises a good point there. And one of the things that I do want to give her and the House Revenue Committee credit for was when the Senate passed 1529, the bill that ended Oregon's tax haven law, they did not include the study that the representative mentioned will be conducted by the Department of Revenue, or I believe the Legislative Revenue Office. Some state employees who work on revenue will be completing that study, looking at the intersection of the tax haven law and the new Tax Cuts and Jobs Act. And we'll be reporting back, I believe, in December 1st of 2020 to let everyone know, sort of based on the data that they've gotten in over the next couple tax years, what that looks like. And that study didn't even exist when the Senate passed that bill out of their chamber and sent it to the House. And so it was really something we were thankful to see at least that study be included, even if we would have preferred one of the earlier versions that would have brought it back, as the representative mentioned.
Yeah. Jody, let me add on your question about the corporate minimum tax and corporate income taxes. We think it makes a lot of sense to continue to talk about the corporate income tax going forward. We have to keep in mind that corporations just got a huge tax cut at the federal level on the corporate income tax, down from 35 to 20%, I believe. So certainly it's an area, a discussion that Oregon needs to have about recapturing some of the revenue given away at the federal level. And also, going back to the point about the commercial activities tax, the corporate minimum tax is, in effect, a commercial activities tax, a very modest one. And so certainly there's plenty of room there to bump up the corporate minimum as a combination. But this is certainly part of the conversation that we hope to have going forward.
Juan Carlos raises a great point there. And I think that one of the alternatives that wasn't discussed in too much detail last legislative session on the tax reform effort was actually keeping our corporate income tax and implementing a commercial activities tax, and then having them pay the higher of the two, to ensure that there aren't folks who would, corporations or businesses that would really win by shifting all the way over to the commercial activities tax, and to preserve as much revenue as is logical from both of those sources. So I think there is some path forward that is sort of all of the above, that includes a commercial activities tax as well as enhancing our corporate income taxes.
We have another question from John. He says that he's disappointed that the kicker was not part of the discussion this session. That if we had taken prior action, we would not be giving away $464 million in tax credits with a median value of $89, and that whether this money should be spent on preparing for emergencies such as the big earthquake that sooner or later will hit Oregon, or other emergencies. So could you say something about the kicker?
Yeah, the kicker, it's interesting. Since it became enshrined in the Constitution, along with many other strange and terrible things that continue to exist in the Oregon Constitution, it has not, despite the fact that even most Republicans will say, certainly privately and some of them publicly, that the kicker is an illogical, concept that really not only doesn't make sense, but it's harmful, penalizes us, penalizes the state in good times, makes it harder for us to do rainy day savings. There has not been significant conversation about repealing it. There are items, now you get it as a credit on your taxes. You used to, there were all sorts of like big showy ways that it used to, you used to get a check actually cut and sent back to you separately. Now, both to kind of bring down its profile overall and to save a lot on administrative costs, you just get it as a credit on your taxes as part of your tax returns. I agree that it's a bad idea. It is illogical and impractical, and I would certainly support the repeal of it. It's no small thing that we did through a ballot measure, repeal the corporate kicker, and that now goes into the rainy day fund, either the rainy day fund or the education stability fund. I honestly cannot remember which. I think it is the education stability fund. But that was both good and bad. And speaking as somebody, I gathered 100 signatures for that ballot measure when it came out. Before I quite realized that the problem with disconnecting the corporate part is that's the easy part. That is the easy part to explain to people that people don't like and are happy to push back. And now when all we have left is the personal part, that is, that people consider it their money, it does make it harder to change that part as well. The one silver lining I do feel the need to point out, because this was part of one of the last days of the discussion in the House Revenue Committee, is we financially are in better shape as far as the rainy day fund and the education stability fund goes than we have ever been. It has been through the determined work of the last couple cycles of budgeting that we have maintained a good ending funds balance, a good rainy day fund balance, a good education stability fund balance. Now, could it easily be wiped out by one good downturn? It sure could be, and probably will be. And that being said, at the same time, we are better positioned right now for that inevitable rainy day than we have ever been. We've never had such stable financial footing for the future downfall that we know is going to happen.
That's a really good point. And I think the kicker is such a fascinating piece of policy because it essentially does ask a government office, the Office of Economic Analysis, which is a handful of people, to forecast the national and state economies and then figure out how all of these different pieces of how we raise revenue interconnect and forecast that out a couple years in the future within 2% of the sort of margin of error. And if they miss that 2%, the entire difference that it's over what they forecast goes back to taxpayers. And so it's really a very strange policy that in many ways it's surprising we don't have a kicker every cycle unless there's a downturn. But it's certainly one that how it's designed right now, there's a ton of potential for improvement, including how it's dispersed back out, even if we keep it, whether or not it be routed into the rainy day fund, or whether or not, as John mentioned, these funds can be put into a standalone sort of savings account or other fund that could be spent on natural emergencies, natural disasters, such as the big one or wildfires or other needs that the state might have. And so I think that we at OCPP are certainly always happy to have that conversation. around how can we reform this inane tax policy in a way that really makes more sense and helps Oregonians.
And I also, the other thing I just like to throw out, in case you just thought it was ridiculous that we require this 2-year forecast to be within 2%, or else all of the excess, gets reimbursed, doesn't get invested, doesn't get saved. It is what the baseline for it, for the kicker, is the last forecast at the end of the long legislative session. So for example, if we in the next legislative session pass a new tax, if we voted 60-0 and 30-0 to pass a new tax, it wouldn't matter, because the getting of that tax would not have been in the forecast, and so any of that went above that the projection, which is, I mean, that's ridiculous. I mean, that is even more nonsensical than the overall premise, is that it doesn't matter. It doesn't matter if the federal laws, for example, change. If we had early in the conversation about the Trump tax scheme, there was all this grandiose talk about, oh my gosh, the states are going to do so great in this. We're going to have this big, because of the federal tax cuts, your state income, you're going to be able to write less of that off in your state income. So you're going to have this big boom to states where they're going to get all this new revenue in. Well, it didn't end up working out that way. Certainly not for Oregon. But if it had, that would have triggered the kicker. That would have triggered the kicker, even though that was legislation that was just a gleam in Donald Trump's eye when, at the time of the forecast, the last forecast in May of 2017, doesn't matter. It's all that matters is that forecast number. And you can't even take into account changes in laws, changes in anything else. So if you thought it was bad to begin with,
it keeps getting worse.
The more you know, the worse it is.
We have another question from Dale. He's asking, what is the Joint Committee on Student Success? What's the purpose of it?
Oh, sure. Just the best idea ever. So the Joint Committee on Student Success was established, I believe, in January. The Joint Committee on Student Success is an example of success has many fathers. Failure is an orphan. Isn't that the line? So I had the privilege of serving on the joint, I just call it the Joint Transportation Committee, but it had a much longer name.
Committee on Transportation, Preservation, and Modernization.
What Daniel said. So that committee was established in 2016. And the idea was, let's put together a committee, House and Senate members, Democrats and Republicans, we know we have transportation needs across the state. Let's go around the state and see them and talk to community members and see projects that have been done and projects that they need going forward. So the Joint Transportation Committee spent about 6 months of 2016 traveling around the state, visiting every corner of the state, every size metropolitan area, and talking to local electeds, community members about what they wanted for transportation, what kind of investments they wanted to be made, how they were willing to pay for them. And then we took that information and went back, and in the 2017 session, that same joint committee then met formally as a committee and put together a significant transportation policy package that had a lot of great things in it. The first statewide source of transit funding that we've ever had, the ability to do congestion pricing, which is truly, given the growth in this state, we cannot pave our way out of congestion. We cannot urban plan our way out of congestion. We need every tool. We cannot switching people to bike and walk and transit our way out of this. We have to have a combination of those things, and we need to do congestion pricing. Because that is truly the only thing, the combination of all those things are what we need just to keep up with our growth, let alone manage our congestion going forward. So a huge package. We had, and as you know, in Oregon, we need a supermajority vote in order to pass any tax increases. So the transportation package, significant package, lots of new taxes, lots of tax increases. We got over 40 votes in the House and I think 20 votes in the Senate. And so, because that was a success, the leadership in the House and Senate kind of looked around and thought, I wonder if we have any other pressing problems that might be a good solution for. And that is where the idea for the Joint Committee on Student Success came from. Let's put together a group of legislators, House and Senate, Democrat and Republican. Let's travel around the state and talk to students, teachers, parents, community members, administrators, what is working and what is not in our education system. We talk all the time about how the most important thing is a high quality education for our students. What does that mean? Let's go around and let's go and see places where they are, where we're achieving that. Let's see places where we're not. What are the roadblocks? What is keeping districts from being able to do it? What's working, what's not? And then let's put together ideas about how to create that and potentially come up with a revenue source for it. So if we can, the idea is that we will travel around, we will come up with ideas about how to best create this. And it's not a new plan. I have very carefully, I refused, and all the materials we were putting together at the beginning, I'm like, no, we are not coming up with a new plan for education, because education is particularly sensitive to being a flavor of the month. Everybody's, oh, now, hey, here's the greatest new thing in education. Hey, here's the next new thing in education. There's so many people who know lots of things about education. How about if we go talk to the people who are experiencing it and seeing if we can just come up with an agreement on what do we mean by a great education for all of our kids. And then, so what policies might we need to do to implement that? It might be, there's a surprisingly small amount of accountability for education funding in this state. It's centralized funding. We do it out of the state. We send it to the districts, and then they do with it what they will. They have local elected boards, they would argue, and they're right, who help oversee and have feedback and accountability there. But we as a state, if we have goals that we want to our kids to achieve, whether it's graduation rates, whether it's reading rates, whether it is successful transition to jobs, whether it's getting kids out of ELL, whatever it is, why shouldn't we have some say in, hey, let's steer some of this money to those particular goals? There's not been much of that yet. I'm not sure where we're going to get to, honestly, but we are scheduling. The first meeting is next Thursday, March 22nd in the Eugene Springfield area. And we're going to also follow the model of the transportation. We're going to have kind of some small group meetings with stakeholders. We're going to do tours to different education sites. And then we're going to have a public meeting every place we go. And hopefully get to some agreement on what a great education means, and hopefully come up with a dedicated funding source for it. Ever since Measure 5, which switched responsibility for education funding from property taxes and at the local level to the state level, we have not replaced that funding source. So that has been a big part of our issue. So I hope that, I'm really looking forward. I'm the House Chair. Arnie Roblin from Coos Bay is the Senate Chair. And we already started during the short session having just some introductory meetings just to kind of lay the groundwork of how does funding work now, who is accountable for what, who is responsible for what, in all the different levels. And now we're going to head out around the state, and I'm really excited about what we'll hear from folks and what we'll see, and hopefully it will be as productive and successful as the transportation work was.
Thank you so much, Representative Smith-Warner. We've reached the end of the questions and end of our time. So, and thank you all for taking time out of your busy day to join us. So if you have further questions, feel free to email them to us. And a reminder, we have an action alert that we're trying to encourage the governor to sign Senate Bill 1528. So please take a moment to go to this webpage. Thanks again, and we'll be sending out new webinar invitations pretty soon. So stay in touch.
Thank you.